Good afternoon, it's 1 o'clock and time for the Wall Street crossover show sponsored by Admiral Markets and featuring their senior market commentator, Darren Sinden. How are you today, Darren?
Well, it's still full of cold, Zach, but pleased it's heading towards the weekend.
Well, you seem to be better than I am, actually. You seem to be, you were worse yesterday. But anyway, you've bounced back. The market's not bouncing back, though.
No, I mean, to be honest, there's not much incentive for them to do too much ahead of the weekend. Obviously, the big news is Wednesday, Thursday next week with the Fed and interest rate decisions, and I can't think that there are any prizes for being brave ahead of that, where it's still in the balance, and could go either way. Although we think they won't raise in September. There's nothing to stop them, playing beggar thy neighbour and doing it anyway. Right,
and the other point is, I mean, could the market surprise us and just go sort of totally dead waiting for that rather than...
It's quite likely that it will, I think. I mean, as I say, if I were managing a significant portfolio at the moment, I would be very happy to be on the sideline and just watch from afar, as it were. And then you'll be a much wiser and better informed person, next Friday than you are today.
Okay, well, let's look at the data released over the European session.
Okay, well, quite a few data points today, but I've just picked out three which exemplify our idea of an uneven European recovery. So first of all, in Germany, the Harmonised Index of Consumer Prices, or HICP, this is the ECB's preferred measure of inflation. And we look here at the numbers for August on a year-on-year basis. Plus 0.1% was the read. That was bang in line with the forecast of plus 0.1%, and the prior read, in fact, of plus 0.1%. So in Germany, there is very, very modest inflation, and it's not growing or changing, as we can see. Meanwhile, the same number in Spain came in at minus 0.5%. Again, bang in line with both the forecast and the prior read at minus 0.5%. So there is disinflation, or if you prefer, outright deflation in Spain, despite their economy bouncing back very strongly. And then to further muddy the waters, if you like, Italian industrial output numbers for July, year on year, and they've had a storming result here, plus 2.7%, 3 times the size of the forecast of plus 0.9%, and an even bigger multiple above the prior read of minus 0.3%. So something went very right for Italy during July. The question, I suppose, is whether they can continue to do that.
Well, they deserved a break, I think, after all. Yeah. I think there's only been bad numbers in the recent past. Okay, let's move on to the European movers. Okay,
well, a couple of names took my eye this morning. First of all, Regis, RGU in London, 302.6 pence, up around 2.7% today. Probably one of the world's biggest providers of serviced office space, both here and in Europe and in the US. And there was talk around this morning in the market that they had received a bid from an unnamed private equity group which valued the company at around £3 billion. That's a small premium to the current market cap, which is around 2.8 billion. I think the market wants to see a bit more flesh on the bone to this story before it gets too excited, and obviously that
might want to see a bigger offer as well.
Well, that's also true. It's not exactly a tempting premium, is it? So anyway, one to keep an eye on from here, I'm sure. And then moving over to France, Total, the big French oil company, FP is the ticker in Paris for those, €40 and 42 cents, up about 1.2%. Not a huge move. But they've been upgraded to conviction list buy at Goldman Sachs, and they cite strong cash flow and an attractive downstream set of operations as reasons to be into Total. What is interesting, of course, is to point out that in the same note, Goldman dramatically cut its forecast for both Brent and WTI crude oil prices. So I suppose against that background, they're probably doing quite well to be up at all. But
the people who brought us the $200 a barrel target.
Well, that is true, and I did wonder if the same people making their call, the lower calls today, were the ones that talked about the commodity super cycle and that notorious $200 a barrel figure. Of course, we did get relatively close to that, so it might seem fanciful now, but at one point we were at 150. It didn't seem so far-fetched.
Okay, let's go on to the M&A, rumours and movers.
Okay, well, it's been impossible to stay away from the pharmaceutical and biotech area this year for various reasons, and news of a potential takeover comes from those very sectors today. Actelion, which is ATLN in Switzerland, trading around 133 0.8 francs, down 2.5% this morning, are in talks to buy US rivals ZS Pharma, and that's ZSPH in the US, $78.28. They're trading at 4.75%. Actelion is Europe's largest biotech company, if you're not aware of the name, and ZS Pharma is a relative minnow in the States with a market cap of around 1.5 billion. Actelion's market cap is about 15 billion Swiss francs, but ZSPH or ZS Pharma are up 37% on the week. So this deal has sort of been leaking out, or the expectation of this deal has been leaking out, and the price has moved accordingly, and they may well go higher today. Talk is that Actelion is rumoured to be prepared to pay as much as 2.5 billion to secure ZSPH. So obviously, well, we're talking about the best part of a 60% premium there, if that were the price. And it's originally said to put out feelers to the ZSPH management back in August.
It does suggest that it's not too late to join the party.
No, quite possibly. Just to see why they might want to get together. Actelion is a leader in heart disease treatments, whilst ZSPH has drugs to treat excess potassium buildup, which apparently, if untreated, can cause heart failure. So it's very much in the cardiac area. Probably some people who own a ZSPH or have sold them recently may have had a heart attack when they saw the moves this week. Anyway, one to definitely keep an eye on, and I'm sure there'll be further news to follow on this.
All right, let's go on to the US data points.
Okay, well, a couple of data points, the most important of which probably is the producer price index for August. We look here at the month-on-month number. Forecast is for a further decline of minus 0.2% against the prior read of minus 0.2%. This will be one of the areas that will be, I should say, supportive of the dubs in interest rates in the US. And obviously the lower producer prices go, the lower that any measure of inflation goes in the US, the less likelihood that the Fed would raise rates. Of course, they could just look through that data and look at some other measures. So we'll see what that number comes out at. And then the old Marmite number of the week, University of Michigan consumer sentiment. You love it or hate it, but the forecast is for a slightly declining consumer sentiment with a read of 91 versus the prior read of 91.9. And again, make what you would of that. Obviously, a better number suggests a better economy. A lower number suggests that things are going the other way.
All right, let's have a look at the US pre-market movers and levels.
Okay, well, a couple of new names to the show. First of all, Premier Global, which is a collaborative software group, make programs that allow you to work collectively online from remote locations. $13.81, up 21.6%, and they've received a bid of $14 per share from a US private equity firm called Cyrus Capital, hence the sharp jump there. And then going the other way, a company called Zoomies Inc., that's ZUMZ, in the US, $17.26 pre-market, down around 20.3%. And this is the latest in a line of casual clothing retailers in the US to give disappointing guidance. Like-for-like sales were down 4.5% in Q2, but much worse than that, they trimmed their forecasts of revenues and earnings in Q3 by around 10%. So
sort of follows on from the likes of Gap and
and American Apparel. It's a difficult space to it seems to be.
What are people doing? Wearing less clothes? Or what's the strategy?
The competition is so fierce. It's a crowded space.
They're not obviously not buying the big brands. I mean, they're not maybe that's something. Well,
I think that's probably true. I think you can buy clothes in a number of other American retailers. I'm thinking of Walmart, Target, that kind of thing. And elsewhere, and online, of course, from the likes of eBay. So it is a squeeze from both sides by the look of it in that fashion casual retail area.
Okay, let's go on to the levels of the day.
Okay, well, we're easier for choice in Europe this morning, but it's, as you say, it's a relatively quiet session. So 61.20 versus 62.15 covers the FTSE, and 10,060 versus 10,200 looks to be the sort of support and resistance near term for the DAX. Over in the States, a bit of a mixed bag last night. We were better, but we closed well off the highs. So 1930 plays 1965 now in the S&P, whilst in the Dow 16,225 plays 16,355. So that tightened range in the Dow unfortunately proved to be very fleeting. Not too much to report in the currency world, though the euro has firmed slightly against the dollar, so we now have 112.39 as our downside level, plays 112.90 to the upside. Aussie dollar remains above the key 70 level, so 70.38 now on the downside, plays 70.90 to the upside. Dollar yen seems to be stuck something of a red light, so 120.32 now, plays 120.96 as we approach the weekend. And cable, we wanted to see it close above that 154.08 level yesterday, did indeed do that, so that now swaps from resistance to support. And to the upside, I'd like to see it move above 154.47 before I was convinced we're going to make any further gains.
But very quiet, relatively quiet.
Yeah, it is, yeah.
Right, in focus we have the emerging markets.
Yeah, well, we know we've talked a lot about emerging markets, and they often get treated as one asset class, but of course there's many and various different markets within them, and so I thought it might be quite interesting just to have a look at this table, courtesy of Bank of America Merrill Lynch and MSCI Capital International, just to look at some of the the characteristics that we've seen in the markets at the moment. So first of all, we have seen some very sharp falls month-to-date and year-to-date numbers here in the first two columns, and so we can flag here, Brazil month-to-date down 4.4%, South Africa down 6%, even India, which is probably one of the the pick of the bunch, down 2.2%. And if we look out to the year-to-date column, South Africa down 17.3% thus far, and Brazil down 35.7% thus far. But just to exemplify the fact that these things don't all move in line, it's interesting to see that Russia is actually still up 7% year to date.
But Brazil enjoying its newly found junk status.
Yes, downgraded only recently, wasn't it? So, and then if we move across to the next group of numbers, which are related to valuation, it's interesting to sort of compare and contrast what we're seeing here. So the average 12-month forward PE for the emerging market sector is 10.4%. But if we look, for instance, here at Russia, trading on a PE of 4.4%, and then that contrasted with the valuation for South Africa, 14.1%. It would seem to me that there's something ought to give there. So maybe South Africa's too high, Russia potentially too cheap.
But China actually quite attractive.
8.8 times, yes, not too dear at all. And then the next column, price to book value, and I think again quite interesting to see that Korea is just on 0.9 times book value, and Russia a very lowly 0.6%. And again, South Africa there trading at 2.4 times book value, and India 3.1. So a lot of a differential there. I'll leave it to other people to make up their minds about what's right and what's wrong there. And then finally, what are we looking for in terms of 2016 and 2017 in terms of growth? This year, Russia and Brazil earnings there are expected to be completely in the toilet, down 37% as far as Russia's concerned, and 26.2% as far as Brazil. But if we look forward to 2016 and 2017, they start to bounce back. You can see that Brazilian earnings are expected to jump back by 31.6%, and in 2017 by 21. So in Russia, 11.4 plays 18. So whilst we're heading towards the bottom, if not bottoming out at the moment, some people are looking forward 2 years with perhaps a contrarian view, and will doubtless be thinking about trying to find some value in amongst those.
Well, the only thing is it's difficult to work out what sort of magic will appear in 2016, which we don't know about now.
That's true, and it's also true, of course, just because they're cheap at the moment doesn't mean they can't be cheaper. We said that about Russia ourselves back in October last year. So it's probably right to try and keep a watching brief, let the market tell you when it's formed a bottom, rather than going, try and call it yourself. Nonetheless, it is interesting to see that that the great and the good do believe that some of those emerging markets at least will bounce back quite strongly in the next 24 months.
Right. On that happy note, Darren Sinden, market commentator, Admiral Markets, thanks for being with us today. That's it for the Wall Street Crossover Show, sponsored by Admiral Markets. We'll be back on Monday at 1 p.m.